So usually when we look at the local economy, we tend to focus strictly on what we can physically see.
Right.
We look at the new brewery opening up downtown or the construction cranes dotting the skyline.
Yeah, exactly. Because it's tangible.
Right.
I mean, you can physically point to a new manufacturing plant and say, hey, the local economy is growing.
Exactly. Or you see a massive trucking fleet moving goods out on the interstate,
Yeah.
and you focus on that visible movement of commerce. But if you actually want to understand how all that physical movement happens, you have to look at the hidden wiring,
And that hidden wiring is almost always the balance sheet of a regional bank.
which is exactly what we are getting into today. Welcome to this custom-tailored deep dive. Our mission today is to unpack the real-time financial mechanics of a regional bank navigating a shifting economy.
Yeah, and we are using an exclusive stack of source material for this. Specifically, the Q1 2026 earnings conference call presentation from Peoples Bancorp.
Right. We want to cut through all the corporate financial jargon and discover how a bank actually makes its money today, like how it balances high-risk lending, how it wrangles your everyday deposits, and how it executes strategic acquisitions to buy what the industry calls cheap money.
Because why should you care? Right. Understanding a bank's balance sheet reveals the hidden wiring of your own local economy.
Yeah, it shows exactly how your everyday checking account is being used to fund everything from those local breweries to heavy equipment manufacturing.
I mean, a bank's balance sheet is basically the raw schematic of the economy. If you know how to read the mechanics of where a bank is sourcing its money and where it takes risks, you can actually see economic shifts quarters or even years before those construction cranes ever show up.
Okay, let's unpack this. Let's start with the Q1 2026 scorecard for Peoples. They reported $29 million in net income.
Which is solid.
Yeah, and their diluted earnings per share, or EPS, came in at 81 cents. And that EPS number actually beat the consensus analyst estimates of 80 cents.
Right, they beat Wall Street's expectations.
On top of that, their asset quality is looking great. They reported that 98.9% of their entire loan portfolio is considered current, meaning borrowers are making their payments on time, and they had a noticeable reduction in non-performing loans.
Beating estimates and maintaining nearly 99% current loans is it's a very strong baseline, but the nuance here is fascinating.
How so?
Well, the mechanics of how they arrived at that 81-cent earnings beat tell a much more aggressive strategic story. They intentionally absorbed some very heavy one-time expenses in the first quarter.
Right, kind of like taking an A on a report card despite missing an entire week of school.
That's a great way to put it, yeah.
Because why take all these financial hits early in Q1? I mean, the source material details $1.5 million in annual employee-related expenses hitting all at once. That includes like $764,000 for stock grants, specifically for retirement-eligible employees, and another $689,000 in employer contributions to employee health savings accounts.
And they paired those administrative costs with active balance sheet cleanup. So they also took a $900,000 loss on selling an OREO property.
Wait, an Oreo property? What is?
Oh yeah, OREO stands for other real estate owned. It's the banking industry term for foreclosed property.
Oh, got it.
Yeah, banks don't want to be landlords. Holding a foreclosed property requires paying property taxes, maintenance, insurance. So taking a $900,000 hit to sell it immediately, it basically stops that slow bleed.
Makes sense. And they also took an $800,000 loss on redeeming subordinated debt, right?
Right. So subordinated debt sits lower in the capital stack, which means it's riskier for the investors who hold it, so the bank usually has to pay a higher interest rate on it.
Yeah.
If a bank wants to pay off that expensive debt early, they often have to pay an early redemption penalty to the investors. That's the $800,000 loss. They paid a premium to shed an expensive long-term liability.
So if we look at the mechanism here, they are essentially taking a sledgehammer to their own Q1 profitability.
They really are.
If you add back the HSA contributions, the stock grants, the foreclosure loss, and that debt redemption penalty, that 81-cent earnings beat would have been an absolute blowout.
Yeah, it is a calculated acceleration of pain. By flushing these specific one-time medicine doses through the system in Q1, they clear the deck. It shows the underlying operations are actually stronger than that $29 million net income suggests.
Because management ensures these liabilities won't drag down their numbers in Q3 or Q4.
Exactly. If the macro environment suddenly goes south later in the year, Peoples won't have the carrying costs of foreclosed real estate or that expensive subordinated debt weighing them down.
So to understand why their underlying operations are so strong despite these costs, we have to look at the lifeblood of any bank, which is how they are managing their deposits.
Right. The deposit base.
In Q1 2026, Peoples grew their overall deposits by $192 million. But the total volume is kind of secondary to the actual mix of where that money came from.
Oh, absolutely. The composition of a bank's deposits dictates its structural profitability.
They saw a $102 million seasonal increase in government deposits and a $41 million jump in non-interest-bearing deposits. But the standout move is that they intentionally dumped $154 million in brokered CDs.
What's fascinating here is that brokered certificates of deposit are what the industry calls hot money.
Hot money.
Yeah, it's expensive and highly mercenary. When a bank needs a massive injection of liquidity quickly, they can pay a premium to a third-party broker who funnels institutional cash into the bank. But the problem is, those depositors have absolute zero loyalty. They are parking their cash there strictly for the yield. The moment a competing bank offers, a fraction of a percent more, that money just evaporates.
So by intentionally shedding $154 million of that hot money,
Yeah.
they were able to replace it with deeply local, highly granular deposits.
Right.
The presentation notes that 77% of their funding now comes from retail customers.
Yeah.
And the math on those retail accounts is the real eye-opener
It
here.
really is.
The average retail account holds $27,000, but the median account holds just $2,900.
And that huge gap between the 27K average and the $2,900 median is the defining characteristic of grassroots funding.
Yeah, it means a handful of very wealthy clients or local businesses are pulling the mathematical average way up, but half of every single account at the bank holds less than $2,900. This is the definition of everyday community money.
Right, and sourcing money in those tiny $2,900 increments requires physical branches, tellers, mobile apps, local marketing. It is a massive operational lift compared to just, making a phone call to Wall Street to buy brokered CDs.
It's like switching from buying expensive imported bottled water every day to just installing a highly efficient tap filter at home. It takes more work up front, but the unit cost drops to almost nothing.
Exactly. And the payoff for that operational lift is a drastically lower cost of capital because they swapped out the expensive mercenary hot money for everyday community deposits. Their net interest margin actually expanded by 4 basis points to 4.16%.
And net interest margin, or NEM, is just the spread between the interest a bank pays out on your deposits and the interest it collects on the loans it issues, right?
Yes, exactly. Expanding that margin by 4 basis points, which is just 0.04%, might sound microscopic, but across a multi-billion-dollar balance sheet, it is a massive strategic advantage.
So they have secured this incredibly cheap, highly stable funding base. But cheap funding doesn't generate $29 million in net income if it just sits in a vault.
No, it definitely doesn't.
They have to deploy it into higher yield environments to actually make a spread. Which brings us to their riskiest portfolio, a division called North Star Leasing.
Right. North Star Leasing operates in a highly specific, higher-risk commercial sector. They provide equipment leasing for heavy industries. So we're talking commercial trucking, heavy equipment, restaurants, breweries.
And here's where it gets really interesting. The origination yield on these leases is hovering around 20%.
Which is a massive return.
Massive. But it's also responsible for the bulk of the bank's recent net charge-offs. And a net charge-off is basically a loan the bank has officially written down as a loss, right?
Yeah, they recognize they aren't going to collect the full balance. And in heavy equipment leasing, high charge-off rates are just a structural reality. Small and medium commercial enterprises fail at a steady rate.
Trucks break down, restaurants go under.
Exactly.
It's basically the spiciest item on the menu, right? It brings in the thrill of that 20% yield, but it risks the heartburn of charge-offs. So if small-ticket leasing is driving almost all the charge-offs, why keep doing it at all?
Well, it connects to the bigger picture. Even with higher charge-offs, a 20% yield provides a diversified revenue stream that strongly boosts that overall net interest margin we just talked about.
Ah, right. The winners pay for the losers.
Exactly. And containment is the entire strategy here. Peoples is actively de-risking the segment. They completely stopped originating high-balance leases, which they define as over $300,000 back in mid-2024.
Oh, wow. They just completely cut it off.
Yep. They shrank that specific exposure by 85%, bringing it down to just $9.4 million. Now, their small ticket lease balances make up less than 2% of their total overall loan balances.
So by intentionally capping the North Star portfolio at under 2% of total loans, they control the blast radius.
Precisely. If the commercial trucking sector experiences a sudden wave of bankruptcies, the resulting defaults are ring-fenced to a tiny fraction of the balance sheet.
Meanwhile, the 20% yield on the performing leases continues to pull up the bank's overall margin. They're using their cheap $2,900 retail deposits to fund a highly lucrative, strictly contained commercial leasing engine.
It's a really smart balance.
So they've optimized their deposits, and they've successfully contained their high-yield leasing risks. But to keep growing, they need more cheap capital to deploy safely. Enter the merger.
Yes, the Citizens National Bank buyout.
Peoples is acquiring Citizens National Corporation, or CZNL. It's a 100-plus-year-old bank with 12 branches in Kentucky and $686 million in assets.
And Peoples expects a 5.6% EPS accretion, so a direct boost to earnings per share in 2027 from this deal.
But the geography of adding branches in Kentucky is kind of secondary to the real gold mine here, which is CZDL's balance sheet.
Oh, absolutely.
They have a ridiculously low loan-to-deposit ratio of 58%.
Huh.
And their cost of deposits is just 1.27%.
And furthermore, 92% of their funding is core deposits, with absolutely zero brokered deposits.
Zero broker deposits. Wow.
Yeah.
But let me push back on that 58% loan-to-deposit ratio for a second.
Sure.
That means for every $100 deposited by the local community, Citizens National is only lending out $58. The other $42 are just sitting there. Isn't having almost half of bank's cash just sitting there totally inefficient? It sounds like buying a giant reservoir just to water your own crops.
Well, this raises an important question. It is highly inefficient for Citizens National as a standalone business, but that is exactly why it's a brilliant acquisition for Peoples.
Because Peoples has the lending engine.
Exactly. Peoples has that highly tuned engine capable of deploying capital into 20% yield leasing structures. What they need is raw liquidity. CZNO is basically a massive, cheap fuel tank. By acquiring them, Peoples takes that unutilized 42% of deposits, costing only 1.27%, and immediately pumps it into their own higher-yielding pipelines.
But taking on another bank's loan portfolio always carries risk, right? Like inheriting hidden toxic assets.
It does, which is why, to ensure safety, Peoples reviewed roughly 90% of CZNL's loan balances during due diligence.
Wait, 90%?
Yeah, which is practically unheard of in regional bank acquisitions.
I was going to say, that sounds insane.
A typical due diligence process might sample maybe 30 or 40% of the target's loans to establish a general feel for the credit quality. Doing 90% requires a massive upfront expenditure of resources.
You're deploying armies of credit analysts to manually scrutinize individual files. But by doing that, they effectively eliminated the risk of post-merger surprises, making this an incredibly safe bet.
Exactly. They know exactly the quality of the fuel they are pouring into their engine.
So with this new, cheap fuel tank attached to their engine, how does Peoples view the bumpy economic road ahead for the rest of the year?
Well, Peoples release their 2026 outlook. They anticipate positive operating leverage, meaning top-line revenue growing faster than operational expenses.
And they're projecting steady non-interest income of about $28 to $30 million per quarter.
Right. And they expect loan growth to hit the low end of their 3 to 5% guided range.
The most fascinating part, though, is how they project their net interest margin. They expect their NIM to stay between 4% and 4.20%. But this model assumes exactly one 25 basis point rate cut from the Federal Reserve for the entire year.
Just one.
Yeah. And they openly note that every 25 basis point rate cut actually shrinks their margin by 3 to 4 basis points. So what does this all mean? Isn't basing your whole year's outlook on exactly one Fed rate cut like trying to parallel park a bus blindfolded? Like, what if the Fed holds steady or cuts 3 times?
Well, it isn't gambling, it's defensive modeling. The mechanics of a rate cut depend entirely on how fast assets and liabilities reprice. The presentation notes that 58% of People's loans are variable rate.
Meaning those loans drop instantly the day the Fed announces a cut.
Exactly. The bank's revenue takes an instant hit, but the deposits, the liability side, are sticky. Peoples can't just instantly drop the yield on thousands of retail accounts without risking a flight of capital to competing banks.
Ah, so loan yields drop instantly, but deposit costs decline slowly.
Right. And that spread compression is why a 25 basis point Fed cut results in a 3 to 4 basis point shrinkage in their margin. So modeling exactly one Fed rate cut isn't an attempt to predict the future perfectly.
It's a built-in buffer.
Exactly, because a rate cut slightly hurts their margin, predicting one cut is a safe, conservative middle ground. If the Fed doesn't cut at all, Peoples will likely beat their own margin guidance.
And if they cut twice, the extra compression is minor enough to be absorbed by the efficiencies from the Citizens National merger.
Precisely. And aiming for the low end of loan growth shows they aren't swinging for the fences in a weird macro environment. They are playing it safe and steady.
So when you pull all this together, you see a regional bank thriving, not by making wild bets, but by meticulously cutting expensive funding, managing the exact percentage of their high-yield risks, and buying up cash-rich, loan-poor neighbors.
It's a highly calibrated system.
Before we wrap up, there is one final mind-expanding idea buried in the presentation that we haven't discussed yet.
Oh, what's that?
Well, the presentation noted that Citizens National's top 25 depositors have been with them for an average of 13 years.
13 years. That is incredible loyalty.
It is. But that loyalty created the cheap 1.27% money that made the bank a prime acquisition target in the first place,
Right.
which makes you wonder.
Yeah.
As larger banks buy up smaller ones for their cheap, loyal deposits, does customer loyalty actually cost the consumer?
Oh, wow.
I mean, if you've kept your money in the same hometown bank for a decade, are you effectively subsidizing the profit margins of Wall Street or a regional giant by missing out on higher yields elsewhere?
That is a fascinating paradox. Your deep trust in the local institution is the exact asset being monetized.
Exactly. It's something to really think about the next time you look at the interest rate on your own savings account. Because your money isn't just sitting idle in a vault, it's the hidden wiring powering the entire economy. Keep digging, keep questioning the systems around you, and we'll see you next time.